stocks. All right, so we have a market that is still bullish, quiet. Let me increase the size just a minute. There we go. Okay, so we got a bullish normal market, and it is neutral on an annual basis and on a 10-day basis. Looking at on annual, we're looking at weekly RSI 14. It's rated at 68. Now, when it hits 70, that will go to overbought on an annual basis. So we're getting close to overbought. On a 10-day basis, we're at 69 out of 100 on the 10-day NDX, so we're at the high end of normal. The slope, the stretch relative to the 200-day moving average is at 12.07%. That's green bullish. That's very strong. The slope of the 50-day moving average is at 0.85, and that is white bullish, so slightly less strong, but still bullish nevertheless. ADX 14 at 32.1 is still a very strong bull. However, it has backed off 2 points since last week when it was above 34. It's hard for SPY to stay above 35, and but it's still at the high end of strong right now. Relative volatility is at 0.88%, and that's coded at normal. And 0.88 would have been deep in the quiet zone as little as a month ago. But as the market has continued to go up and volatility has declined, what used to be quiet has become the new normal as a new sense of complacency enters the U.S. market. And complacency is good for long side. So, bull quiet, market neutral. We did blended monthly rebalancing this past week. Now, make a pen and ink correction on your paper. It says next reevaluation is on or about 1 April. That should read 1 May. But these are the current holdings as of 1 April. In the 26 ETF portfolio, it is the NASDAQ, Qs, financials, XLF, and I'm going to recommend MDY, the mid caps. We're going to see when we look at page 2 that actually GUR is in the third position, and that's the emerging European market spider. But it is still very, very low volume. And although I like the asset class and I like the strength in Europe, it still was really too low volume for us to use yet. And so I'm going to leap over that and go to MDY, which is in the fourth position. The 13 ETF portfolio is all U.S. in the risk-on trade. It's the Qs, mid-caps, and small caps. So the next evaluation on or about 1 May. That should read 1 May. In ETF 2, the theoretical exposure is at 100%, and the model portfolio is at 100% exposed. That's all the same, excuse me, all the same holdings, but with stop losses adjusted. Moving on to page 2. And let's see here. Looking at the 13 ETF portfolio, these are sorted by the strength column. Again, you see the Qs, MDY, and IWM. That's all the risk on. And then SPY is in the fourth position. Latin America has and emerging markets have made a stealth comeback, and they're better than the rest of the globe. Treasuries are at the bottom of the stack with and TLT, the long-term treasuries, is the only symbol that's on a sell. In the 26 ETF portfolio, again, you see GUR is rated at 80, but because it has such low, excuse me, it has such low average volume here at 24,000 shares that I can't recommend it yet. But I want to track the track the sector. I just don't think that it's ownable yet. So that's why I recommend XLF, the Qs, and MDY. At the bottom, we have all the usual suspects: treasuries, agriculture, short-term treasuries, Swiss franc, emerging market bond, gold, and blended commodities. China continues to trail the rest of the world with the FXI. So moving on. Next up is the market health check. I have this rated at bull quiet. We're so close to the edge on the difference between bull normal and bull quiet that I left this on there for another day. So we're right on the boundary. Although the primary report, and technically we're in at the very low end of bull normal. So the vertical blue lines represent 10, 20, and 30 days of look-back period. The black line in the middle is the 30-period regression line. The outer black lines are the regression channel formed by the maximum excursion from the regression line during the look-back period. And then I've projected forward the regression channel, which is where price ought to continue to go pending any change in the state of nature. Horizontal red lines represent previous support levels. The first red box is minus 5% from the swing high, which is at 142. So if we lost anywhere from 0 to 5% off of a high of 142, it would fall in this box, and that would be considered random noise or market noise. The second box is if we lost between 5 and 10%, and that would be described as a correction inside a bear market, or inside a bull market, excuse me. That would take us all the way back to 128, and right on the boundary of the 200-day moving average, which is reflected in the shaded blue area. So we have price right on the regression line, right on the 10-period moving average, right in the middle of the regression channel, which is a strong up. Price and the 10-day are better than the 50-day moving average, which is better than the 200-day moving average, and we're pulling away from it still. So that's sort of a classic bull market. We have ADX back up to just a shade over 31. We dipped into the median range of Williams percent R. We've started to hook back up. The jaws of PPO, which is the percent price oscillator, which acts like a MACD histogram, have opened to the downside. So that's the intermediate term is starting to weaken a little bit, because as you can see, we've had two pullbacks here in the last 10 days, and this previous stronger pullback, which was markedly different than the grinding quiet bull that got us up to 138 in the first place. So it's starting to weaken just a little bit, and that's why the PPO jaws are pointing to the downside. The slope of the regression line is still positive and starting to rise. So we have basically a classic bull market here, getting a little bit long in the tooth as we measure, looking at ADX and PPO, but still it managed to get through 137, the previous swing high, and it's holding above there. And so until it cracks below that, then we have to say that the bull is intact and going forward. Next chart. Next up are the 10 main regions of the world market model in the ETF2 database. You can see they're all on a buy based on their moving average filter. So that keeps the allocation model at 100%, and the model portfolio is also at 100%. Right now, SPY is better than EFA. So 73 in SPY is better than 66 in EFA, which is the rest of the world. Inside the U.S., it's the Qs, SPY, mid caps, and small caps, and that's a risk-on large cap trade. The two strongest sectors based on the average column are the Qs and the SPY itself, and then the two weakest are Japan and the Euro-Asia blend. So little change in the market this week compared to the last really 2 months. Next up is the world market model. And we have the U.S. is well above average, and NASDAQ is exceptionally strong based on the contributions of Apple, which is in nosebleed territory, and absolutely not supported on the basis of their financials. I think this is a case of institutional money has to own Apple, and they've been driving that price north. There's more and more talk on the street about this being, a trading boom rather than anything fundamental. I'm cautious about Apple. In Asia and Asia less Japan, see Japan lagging, Asia less Japan leading. China and India are lagging along with Japan, and then all the other suspects are winning with the most strength in Singapore and South Korea. Latin America emerging markets, Mexico, Brazil, all above average. Only Canada is lagging. I think that's tied to the weakness in commodities. Oil and gold, you see, lagging. Silver is above average, but treasuries and bonds are getting smacked. And U.S. real estate is above average. Europe is a mixed bag with Germany leading, Spain lagging. The risk-on trade is still working with materials, financials, industrials, and tech, all well above average. Only energy lagging among the aggressive business sectors. The defensive plays of staples, utilities, and healthcare all lagging, especially utilities. That's really the risk-on trade when utilities are getting smacked that badly. Moving on. Top 30 ETFs from the ETF2 database. It's the same winners at the top, and that's home construction, U.S. technology, the Qs. Unbelievable. Look at the strength here. And this is Apple. Regional banks, more biotech, retailers, S&P biotech, semiconductors, technology, retail, biotech, financials, banks. And so what's interesting to note is how many of the XL series. You have discretionary, you have financials, you have technology, and even the Qs. And it is really remarkable to see big fat U.S. indexes like that so high up in the list. And that tells you just how much money has been flowing into the U.S. based on weakness in the rest of the world. Hard to sustain that, in my opinion, but there it is. The other thing I would have you note, this sort of makes the case why it's asset allocation and not target selection so much. If you picked any of the technology ETFs, you're doing really well. Any of the biotech, any of the financials as well. Moving on. Looking at the Dow 30 now, using the same strategy as the ETF2 database, only now we're going to look purely at the strength column and looking at that blended 3 and 6 month relative strength. And the financials at the top, Bank of America, JP Morgan, followed by some clear winners here of the past 3 months. Home Depot, Microsoft, Caterpillar, Disney, American Express. Laggards, Hewlett-Packard, Verizon, Johnson & Johnson, McDonald's, Procter & Gamble. Alcoa has come pretty far off the list, already up to 56 and above average on strength. So anytime Alcoa is above 10, that's interesting to me. And I like Alcoa above 10, doing pretty well. Only Verizon and Hewlett-Packard are on are below their 4-month moving average, and that's just an indication of how strong the Dow and the U.S. large caps have been. Moving on. Looking at the ETF liquidity report, I'll just highlight the VIX has increased its short-term volatility. It's almost 8% intraday now. Spiders are down 0.88%. NASDAQ at 0.97%. And you can see the extra volatility you get in the small caps and the liquidity, making an exceptional trading target. It's already half again as volatile as the NASDAQ, and almost twice as volatile as the market itself. So a fantastic trading vehicle. Moving on. Last thing on the weekly, I like this volatility chart. There we go. All right, so what we're looking at here is the market volatility study, looking at symbol SPY, looking at its 30-day standard deviation as a percentage of price over the last 5 years, with a 10-day moving average as the black line. And the smaller chart is the 5-year study, and you can see there have been really 4 periods of sharp, surprising, increased volatility. Last one happening in August. All that volatility has now been processed out. And this is part of the reason why the bull market has been so strong. That volatility, as we know, is inversely correlated to market gains, and we are at a period of exceptional quietude right now in terms of the 30-day standard deviation. Now, the market classification uses ATR percentage and only looks at the last 100 days, so this is starting to look like normal now, and it feels like normal. But just to remind you that other periods of normal that felt like this were followed by periods of catastrophic volatility. And so this is just a reminder to us not to be complacent. Okay, we're going to move ahead to the daily report now. I've already covered the top row. So I'm not going to repeat that. We'll go right to the gap stat. Most of the edge is out of the gap stat now on the gap downs. You remember this used to be tilted 14-1 to gap down and then reverse to close higher. That edge has sort of vanished in the last 10 days. 13 times the market has gapped down in the last 30 days. 6 of those times the gap down failed further to close lower for an average of minus 0.27. 7 times that gap down reversed to close higher for an average follow through of 0.36. 17 times the market has gapped up. 7 of those 17 times the gap up has reversed to close lower with an average follow through of minus 0.26. And 10 times that gap up has continued to gain for an average follow-through of 0.48%. So that's really where the edge is. Gaps up should be followed quickly, especially if it seems to be broadly based. See the time series on the Williams percent R, or the 10-day NDX, excuse me, which is came down to hit the midpoint and is now pushing into knocking on the door of overbought again. No signals in overreaction or channeling. If you took the signals in EEM and IEV last week, you're off to a good start on the overreaction system. You can see the daily pivots reflected here. You can see just how much volatility has come out of this market. And again, this used to be in extreme quiet conditions, but now as we keep dropping off these days of excessive volatility, this quietude in here will start to feel more and more normal. Let's see, the 10-day min pain winners. These are the winners in the Dow compared to their highest high of the last 10 days. The ones that are still closest to it: Johnson & Johnson, IBM, Home Depot, Cisco, McDonald's. 10-day max pain are those symbols that have lost the most on a percentage basis from their 10-day high compared to their peers. So in my theory, that makes them candidates for rebound plays. Since I think it's more likely that max pain was an emotional response rather than min pain. So Alcoa, Caterpillar, Bank of America, United Technologies, GE, the VIX, natural gas, oil, miner, exploration and service, and Russia. Have a washout pattern in agriculture, 5 days down in UNG, a 551W in Procter & Gamble. That's one that should be stocked carefully. Channeling in the oil ETF, and in the auto framer, these symbols all test out at better than 2-to-1 reward to risk ratio based on a retest of their 10-day high and simply using a mechanical entry 5 cents above their high from Friday. Verizon, agriculture, coal, Alcoa, Europe, energy, Brazil, natural gas, and blended commodities. We'll see this a little closer on when we look at the tactical screens next. Here's the Dow Tactical. Again, a large number of dojis from Friday. Here's the 551 in Procter & Gamble. Your 5 candidates for max pain range compression: Caterpillar, Hewlett-Packard, Alcoa, Bank of America, United Tech. In the auto framer reward to risk ratio, you'll see the ones that are exceptionally tradable just based on trade location and using mechanical entries. So Caterpillar tests out at 5-1, Alcoa at 2-1, United Tech, Verizon around 3.5-1, Chevron at 4-1, GE at almost 3-1. Next, taking a look at the ETF. Excuse me. Looking now at the ETF tactical. We actually had 2 symbols that closed at new multi-time period highs. IWR, U.S. real estate in Japan. When these symbols over here under the Tortoise NDX flash green, you notice that they're all above 100 or higher. That means that they've closed at or above their trading range for that look-back period. So 102 means that U.S. real estate closed 2% higher, 2% of its trading range of the last 10 days, 2% of that higher than the trading range itself. So that's a large number. It tells you it was a big breakout. Similarly, natural gas is the only thing that broke down below its trading range lows with a -5 on the 10-day NDX. The 2% winners, the percentage winners from Friday were mixed commodities, DBC and DBA. That's why they're coded green on their symbol. And the big percent losers were the VIX, natural gas, and treasuries, and that's why their symbols are lit up in the red. Moving on. Next up, looking at the market mosaic. Again, R squared is still very high at 0.75 for the regression line on SPY, so it's still a good descriptor of the strong uptrend. If you take a look at the time series, the short term, we're still at or above the 10-day moving average of the regression line slope. That's positive. And you can see that we're still only a half a standard deviation above the 6-month average, and so there's room for this rascal to run. We're holding comfortably up here, almost 2 standard deviations above the 6-month average compared to the 200-day moving average, showing a little bit of signs of the market stalling as it's gone sideways here for almost 10 days. So the index is starting to catch it a little bit. I mean, I would also note that we're right at 12% above the 200-day moving average. The strongest move ever in the history of SPY was 24%. So this move that we're currently in is actually pretty impressive. Moving on. Next up is the fraud quality number. Again, a large number of these from the Qs and above have a quality score better than 3-1, which means that there's at least a 2R trade available if you're using a full standard deviation, a full fraud standard deviation, which is 39 cents in IWM, for example, and 20 cents in the Qs. Remember, the standard deviation describes for us, or defines for us, the difference between noise and signal on those intraday moves. We're going to move quickly through the fail stat and into the holding X-day period report. And the main thing to look at on the 5 and the 10-day is I like looking at the Z-score, and you'll see that none of them are above 1.0. They're all pretty tightly clustered around 0. And what that means is this sideways movement of the last 5 and 10 days has allowed the market to cool off a little bit and consolidate, but without giving up its gains. And now it's poised to make another run on the swing trade time frame. Now the Z-scores are just a little bit higher for the 20 and 40, meaning that those moves are still reasonable. Only the Qs are pushing near the 1.0. So the strength in the Qs and really Apple has been the exceptional story. I think it's Apple supporting the market right now. Moving on. On the daily and weekend report, I just want to highlight a couple things from the last seminar out in Raleigh, and I just want to heap some great praise on Ton. What I want to show you is what is possible for intraday trading with limited information and relying really on a state of mindfulness and alertness combined with target selection and reward to risk ratios. This is Ton's performance over the last week. She made 91 trades. Her best winner was 6. Her biggest loser was -1R. She had winning trades on 57 out of those 91, or a win rate of 63%. Her average win was 1.28R. Oops. I'm sorry. I am not showing you my application, am I? We'll try that again. Let me start that over. So this is Ton's trading performance in the live trading week. 91 trades over 5 days. Biggest winner was 6. Biggest loser was -1. 57 of those 91 were winning trades for a 6.63 win rate, and the average R 1.28. 34 losing trades, which is 37% losing trades, and an average loss of -0.84R, with a standard deviation of 1.33 and an average gain of 0.5. That gives Ton an SQN of 3.52 for that week, which is pretty good considering she was trading my systems and not hers. Now, to be fair, the systems are fairly close. We both tend to trade in the moment and sell too early, although she does a better job of holding on to the bigger wins than I do, I think. But I thought that was pretty remarkable performance. The rolling average R just shows you she kind of normalizes out around here about 0.5 average expectancy, and you can see her cumulative R wins through the week. And then this is a scatter plot of all her trades in sequence and how tightly controlled they are, nothing past 1.0. I think that's pretty remarkable. As a point, just a basis of comparison, here were my trades. Let's see. I had 141 trades. My biggest winner was 2.8. Biggest loser -1. 51% win rate for an average of 0.82. I had about 20% of my trades were just scratch, in other words, right at 0, moved to no lose, and then got taken out. And then 30% losers with an average R loss of -0.41. So I tend to get out of the positions quicker than Ton because her average was -0.8, but then she holds them longer than I do. And I think it's because she knows where price is going and I do not. We tease her about that. And here's my scatter plot. Only 3 times did I take the full 1R loss over that period of time. This strategy right here, I just have to tell you, this was really an important discovery for us, was the use of this sideways quiet channel. What I've done is I've been taking the candlesticks off my signal chart. I'm using this orange line now as the price. That's the EMA2, and you can see that here, EMA2. I'm comparing that to the to the blue line, which is the 10-period regression line, which I have been using as a proxy for price. EMA2 is a little more sensitive, as you can see, but they still track pretty well. I found that by taking the candlesticks off, I can pay attention to the signals better. Lisa, she was using frog strategy, and then she was entering sooner than a full frog SD, so basically front running the frog in much the same way that I do, and we were trading really the same targets. And she was also trading this sideways quiet channel breakout, which is really a form of the regression line crossover. So she was doing regression line crossovers, SQCs, and frogs exclusively on just, she had 4 targets a day, and it was just support and resistance, and not sticking around if the trade wasn't working. So this sideways quiet channel breakout was a really important strategy for us this week. I'm ready to start writing that up. This is a picture of, if you were in the chat room, you saw it. This was March 29th. So what's that, like Wednesday, I think? No, that's Thursday. And this is what I was. This is my trades in IWM at the time of the writing. In the green was where I was going long. In pink is where my positions were short. And as you can see, I was I was kind of out of tune with the market until about here, and I started picking up some reasonable wins here. And I like that the average win bigger than the average loss. Got back in tune with the short side here after. When the regression line crossover occurs, what I'm looking for as a way to get in is when the blue line re-enters the river. We're calling the Bollinger Band region the river. In this case, I had tried front running here, and it failed, so I wasn't inclined to get back on the horse. However, when it failed to even get to the regression or the Bollinger Band mean, I ended up getting short again in order to stay tuned with the big move of the day so far, the primary trend of the day. After this period of sideways quiet channel, this breakout here worked out to be really nice for another 1.2. So after a couple false starts here where I was out of sync with the market in these first 2 trades, I got on the right side of the market and stayed that way. And then the sideways quiet channel is a nice way to start looking at the a reversal of the intraday trend. And so that little adventure, even on a relatively quiet day, had me up 2.3 by the time this last trade had cashed. So that's just a sample of the kinds of things we were doing. It was kind of tough. There was only one real runaway trade, breakaway day. That was on Cliffs Natural Resources, and that's the trade that I ended up leaving about probably 12 to 15 are on the table. I got 4 out of the middle on the long side, and then tried to short it, and got stopped out quick, and then it took off, and I didn't have the moral strength or the courage or the energy to keep going after it, and watched it go up about 15 R after I cashed it. So, but the next day I was able to short it and get it back in the other direction with based on a good trading plan. So if you're not feeling it, don't fight it. That's one of the things I noticed that helped Ton be very, very successful this week was that she was not trying to force the trade. If it wasn't working, she's able to get out quickly. If it didn't feel right, she just got out of it and looked for the next opportunity. And by narrowing her scope to about 4 ETFs and stocks that were likely to be big movers that day, she was able to pile in on the ones that were working, and that proved to be really successful for her. Kim, who is another one of the IITM super traders, also had a fantastic week. And again, you trade in this particular style with their regression line crossover. She likes the WMB3, which in my view kind of front runs the frog entries later in the day. it gets in about at half a standard deviation on average, it seems. So we have mounting evidence that that strategy is knowable and teachable, and I'm thinking of doing a workshop out here in Kansas City that looks exclusively at the frog and the intraday stuff, no other strategies. And my idea would be that review the rules on a Friday and do about 100 case studies of practice trades on Saturday and Sunday, and then trade a couple days, Monday and Tuesday, to put it into practice. In my view, you've really got to saturate your brain with a lot of worked examples and practice trades and debriefing in order to get all the little questions out of your head and onto paper and into discussions, so we can trade this at production level. So I got to check with the guys at work to see if I can take some days off without pay, because I've used up all my vacation with the 2 trading workshops so far this week. And I just realized that when I looked at my pay stub, I had no vacation days left. So if I can take some days off without leave, then I'll look to try to do something around maybe July or early August. Otherwise, the next live trading is at an IITM in Raleigh. I think it's in October. So stay tuned to this BAT channel. We'll see what we can get done. But I got some write-ups to do. That's all the presentation I want to make. I was very happy with the live trading. We have more people starting to be able to apply the techniques with confidence. The guys from Marcel from the Netherlands and Peter from the Netherlands both did very, very well, and there seems to be a growing skill set out here with the frog trading and the regression line crossover. We were looking at the regression line crossovers on longer-term time frames. I was looking at multiple charts where I had like 3-minute, 10-minute, 30-minute, 60 minutes, and was using that RLCO chart marking, and that proved to be a very, very effective way to get some of these longer-term trends. What drove that was at a couple fellows from India who have very high transaction costs in India, but they also have longer-term trends because of a relatively inefficient market there. And so while they can't really apply these strategies on the 3-minute, we were looking at 15-minute and 30-minute regression line crossovers as well as the 10. Between 15 and 30-minute RLCOs, there seems to be some real goodness in that time frame. That's slower, and it really allows you, I think, to use this idea to do some swing trading in the big indexes. So we'll try to write that one up too as well. That's all I have for you right now. Just getting ready to root for the Kansas Jayhawks to win the national championship tomorrow. They got their hands full with Kentucky. It's a big, fast, skilled team. But Kansas has not played their best game in the tournament yet, and those guys have a remarkable emotional resiliency and a will to win that holds up under the greatest of pressure. So a lot of respect for them, and looking for a good game tomorrow. So that's all from Kansas. Keep your powder dry. I'll get this produced and hung on YouTube and send out the alert. I'll also post the link in the chat room once it's done. So that's all I got from here. And you guys take good care, and we'll see you in the chat room. Oh, Mike asks, before I sign off, have I seen a moving average which mimics the linear regression 30? No, I have not yet. I've been searching pretty hard for it. I've tried various exponential moving averages. I think that's the answer is somewhere in the exponential, but I have not found one that is adaptive but doesn't overshoot. And the EMA2 is a good one for price. EMA3 is a good proxy for the regression line 10, but on the I have not found anything yet on moving averages that matches the combination of smoothness and yet adaptability of the 30-period regression line. But I'm going to keep searching. If you catch it before I do, please let me know. That's all from Kansas.